SK Hynix stock is down 18%. Micron got downgraded by Citi. Apple is quietly testing chips from a Chinese company that didn't exist as a serious competitor 2 years ago. And the machine everyone assumes controls this entire industry, the EUV lithography system, the one thing America has spent years blocking China from buying? China's memory chips don't even use it. Let that sit for a second. Every headline about China's chip industry obsesses over EUV, over ASML, over the one machine everyone can't get their hands on. Meanwhile, a completely different company just built an $8.5 billion empire using older, less glamorous machines nobody was watching closely enough. And Wall Street is already pricing in the damage. Here's the specific number that started all of this. CXMT, China's biggest memory chip maker, went public in Shanghai on July 27th, raised $8.57 billion, and the stock surged 466% on day one. That's not the interesting part, though. The interesting part is what happened to Korean stocks the very next day, and the day after that, and pretty much every week since. So how does a company nobody in the West could name a year ago end up rattling Samsung, SK Hynix, and Micron simultaneously? Stay with me, because the actual mechanism here has almost nothing to do with the story you've probably already heard about China's chip industry. Before we get into the damage, it's worth being clear about what this video actually is, and what it isn't. This isn't another China is catching up video built on vague optimism. Every number coming up is sourced, dated, and checkable, from CNBC, Reuters, Counterpoint Research, and Citi's own analyst notes. If a claim sounds too dramatic to be true, that's exactly where we'll slow down and check it properly. Let's talk about the damage first, because numbers hit harder than adjectives. SK Hynix has fallen roughly 18% since its recent highs, making it, in the words of one market analysis, the designated loser of this entire story. Micron dropped too. Citi cut its price target from $1,400 down to $1,150. SanDisk sank 12% in a single session. Western Digital fell 7%. The DRAM ETF, a fund that tracks the entire memory chip sector, dropped 4% in one morning. This wasn't a rumor moving markets. This was real institutional money repricing real risk, all at once, across 5 different companies. 5 companies. One morning. That's not noise. That's a market deciding, in real time, that something structural just changed. Here's the reveal that actually explains why. Every single one of those sell-offs traces back to the same uncomfortable realization. CXMT's DRAM market share jumped from 3% to 8% in 12 months. Its revenue grew 8 times over in a single quarter. And it built all of that using DUV lithography, deep ultraviolet, the older generation of chip-making machines that America never fully restricted, because memory chips like DRAM and NAND simply don't require EUV the way advanced logic chips do. Sit with that distinction for a second, because it's the actual headline hiding inside this story. Everyone's been watching the front door, EUV, waiting for China to break through it. China walked in through a door that was never locked in the first place. That single fact rewrites years of assumptions about how this entire trade war was supposed to play out. Export controls on EUV were built to slow down China's most advanced logic chips, the ones powering AI training. Nobody built an equally tight wall around DUV because memory chips were treated as the less strategic, less urgent problem. That assumption just cost 5 companies a very expensive week. Think about the logic that led to that gap in the first place. Export control policy has always been built around a hierarchy of urgency. Stop the most advanced logic chips first, because those train frontier AI models and power weapon systems. DUV-powered memory chips sat lower on that list for years, treated as commodity hardware rather than a strategic choke point, because memory alone doesn't win an AI race the way a cutting-edge processor does. That hierarchy made sense in isolation. What it missed was how much capital, revenue, and market confidence sit inside the memory sector specifically, and how fast a company can scale once the one tool it actually needs was never on the restricted list at all. Now here's a re-hook worth pausing on, because the next fact changes who you should actually be worried about if you're Micron. On August 9th, reports surfaced that Apple has been quietly testing CXMT's memory chips for iPhones and MacBooks, with early conversations specifically about supplying devices sold inside China. Apple. Testing memory from a company that the Pentagon has flagged for alleged military ties. That single detail is why Investing.com called this moment a grenade landing inside a market already rattled by the IPO alone. Apple doesn't leak these tests by accident. Somebody, somewhere in that supply chain, wanted this detail to surface. Think about what that actually signals, though, before you assume the worst. Apple doesn't test suppliers casually. It tests them because a shortage is real, and because the current suppliers can't fill every order fast enough. This isn't Apple abandoning Samsung or SK Hynix. It's Apple hedging, quietly, the way it hedges everything, because the alternative is production delays nobody in Cupertino wants to explain to shareholders. Here's where the story gets more nuanced, though, and where the panic headlines stop being fully honest. CXMT's gross margin swung from negative 113% 2 years ago to positive 37.8% last year. That's genuinely remarkable. It's also still behind SK Hynix's 60.4% margin, because SK Hynix dominates high-bandwidth memory. The premium AI server chips CXMT hasn't cracked yet. Even bulls at Citi frame this as an expanding pie, not a stolen one, since AI demand for memory is projected to keep outrunning total global supply for years. 2 years from bleeding cash to nearly matching Samsung's margin. Whatever else you think about this story, that turnaround alone is worth taking seriously. Compare it to how long it typically takes an established chipmaker to improve margins by even 5 or 10 percentage points, through years of incremental efficiency gains, and a swing this large and this short. A window starts looking less like luck and more like a company that solved a specific set of manufacturing problems faster than almost anyone outside China expected. Let's re-hook again here, because there's a second Chinese company in this story that almost nobody outside industry analysts is tracking. YMTC, China's dominant NAND flash maker. While everyone's been watching CXMT's DRAM numbers, YMTC has been quietly scaling NAND production from 180,000 wafers a month toward 400,000 by 2028. Same playbook. Same reliance on DUV instead of EUV. A second front in the exact same war, opening while the first one was still making headlines. Nobody wrote panicked headlines about YMTC this month. Give it a year, and that will probably change. That's the actual empire in this video's title. Not one company. 2. Building in parallel, across 2 different memory categories, using technology nobody thought to restrict as tightly, because nobody expected DUV alone to be enough. Here's the honest scorecard, because overselling this story would be just as dishonest as dismissing it. What's real? CXMT's capacity is genuinely projected to double by 2028, reaching roughly 17% of global DRAM capacity, up from 13% now. Its bit shipment share climbs from 9 to 12% over the same window. Those aren't hopeful projections from a press release. Those come from Counterpoint Research and semiconductor analysts with no incentive to inflate China's numbers. 13 to 17% doesn't sound dramatic on its own. Multiply that against a global memory market worth well over $100 billion a year, and it stops sounding small. A few percentage points of a market that size translates into tens of billions of dollars in revenue moving from one column to another. And that's before accounting for the pricing pressure extra supply tends to create across an entire sector, not just the company adding capacity. There's also a question worth asking that most coverage of this story skips entirely. What happens to the price you pay for a laptop or a phone if this actually plays out the way CXMT's own projections suggest? More supply, all else being equal, tends to push prices down over time, which is exactly why Samsung, SK Hynix, and Micron have enjoyed such wide margins throughout 2026, thanks to memory staying genuinely scarce. If CXMT and YMTC's added capacity starts meaningfully closing that scarcity gap, the most likely outcome isn't Samsung going bankrupt. It's consumers eventually paying less for devices, while Korean and American memory makers watch their record margins compress back towards something closer to historical norms. What's also real, and this matters just as much, Samsung, SK Hynix, and Micron still control roughly 90% of global memory revenue combined. CXMT remains concentrated in mainstream, mid-range DRAM, not the high-margin AI server memory actually driving this entire boom. If AI demand keeps outpacing supply the way Citi projects, with HBM capacity needs per AI system rising over 400% as chip counts scale, there may simply be enough demand for everyone to keep growing at once, without anyone actually losing ground in absolute terms. Let's rehook one more time before the close, because there's a genuine bear case sitting underneath all of this that deserves airtime too. Citi projects DRAM prices decelerating quarter over quarter through the next 4 quarters, peaking around Q2 2027, then potentially turning negative after that. Memory has crashed before. In 2022 and 2023, Micron and SK Hynix both lost billions after overestimating how long pandemic-era demand would last. If Chinese capacity keeps flooding in at the exact moment AI demand cools even slightly, this entire supercycle could reverse faster than anyone at Citi or Counterpoint is currently modeling. Booms like this one have a habit of ending exactly when everyone stopped expecting them to. That's not pessimism. That's just what the last 2 memory cycles actually did, almost exactly on schedule, right as every analyst on Wall Street was writing notes about how this time felt different. There's a political layer here too that could cap all of this regardless of how the economics play out. CXMT sits on the Pentagon's list of firms with alleged military ties. YMTC carries similar flags. Some U.S. lawmakers have already signaled interest in restricting American purchases of their chips outright, which means the ceiling on this empire might get set in Washington, not in a factory in Hefei. One line from Congress could do more damage to this story than any competitor ever could. Samsung isn't sitting still through any of this either, and its own response tells you something important about how seriously the industry actually takes this threat. Rather than competing directly with CXMT on price in the mainstream DRAM segment, Samsung has been doubling down on HBM4, the next generation of high-bandwidth memory specifically built for AI accelerators, essentially betting that staying ahead on the premium end of the market matters more than defending every percentage point of the commodity tier. If that strategy holds, expect the global memory industry to keep splitting into 2 increasingly separate lanes: premium AI memory where Samsung and SK Hynix defend their lead, and mainstream commodity memory where CXMT and YMTC keep closing the gap 1 percentage point at a time. That split matters for a simple reason. It means the 18% drop in SK Hynix's stock probably isn't about SK Hynix losing its actual business today. It's about investors pricing in a future where the safest, most profitable part of that business, the mainstream tier, no longer belongs to just 3 companies the way it has for the past 2 decades. So watch three things going forward. Watch whether Apple's quiet testing turns into an actual supply deal, or quietly disappears the way plenty of vendor tests do. Watch whether Citi's price deceleration forecast actually arrives on schedule in 2027, because that's the number that decides whether this is a supercycle or a bubble. And watch Washington, because a political restriction could freeze this entire story overnight, independent of anything CXMT or YMTC actually accomplish on their own. There's one more piece of this puzzle worth understanding before we close, because it explains where the DUV machines fueling all of this actually come from. Reports this year confirmed that a low-profile Chinese firm, Shanghai Aishengna Electronic Technology Group, began producing immersion DUV lithography machines domestically, delivering them directly to clients, including CXMT itself. That single detail matters more than it sounds like it should. It means the entire memory empire in this video's title isn't just running on tools America failed to restrict. It's increasingly running on tools China builds for itself, closing the last dependency that could have slowed any of this down. Layer that fact onto everything else in this video, and the picture gets clearer, not murkier. CXMT and YMTC aren't racing against Samsung and SK Hynix using borrowed equipment they might lose access to tomorrow. They're racing using a supply chain that's increasingly domestic, top to bottom, memory chips, lithography tools, and the capital raised to fund all of it. That's the actual difference between a company riding a temporary loophole and a company building something durable enough to survive the next round of export restrictions, whatever those end up looking like. If you want the next update on this the moment it breaks, not after every other channel's already covered it. That's exactly why subscribing now actually matters here. And if you're wondering exactly how China built that domestic DUV pipeline in the first place, that story is sitting right there on your screen. Click it before you go anywhere else. Drop one word before you go. Empire. If you think CXMT and YMTC genuinely reshape this industry over the next few years. Excuse. If you think this is a temporary shortage story that evaporates the moment supply catches demand. Type it now, then go watch exactly how China built the lithography pipeline behind all of this, because that video explains the one piece this entire story depends on.